Hello, my name is Scott Redler, Chief Strategic Officer at T3Live.com. Welcome to the special first edition of Red Dog Rules. This is a new series we're going to be doing probably once a week, maybe once a month, because I think it's very, very important to teach and educate all of you out there on how to approach the stock market on many different time frames. If you watch the media, you watch the news, I'm sick and tired of hearing all the reasons why you should not be in the stock market, all the reasons why, or all the risks of potentially making a loss or a big correction or a crash. No one talks about all the risks of not being in the stock market, not having a 401k for the long term, not having a 529 plan, not picking winners that can make you a lot of money over the course of multiple years, and how to find those winners. Also, how to pick and choose your time frame, whether it is long term or whether it's intermediate time frames like stock picking and finding those stocks you wish you owned 4 or 5 years ago, or whether I'm going to teach you tools and tactics on how to trade actively for cash flow. And some of you do all three. So that's the basic gist of it. The first one I'm doing, if you look right here, is on Facebook. Yes, you've heard of this company, haven't you? Before I get into it, I got to do this. I got to give you a disclaimer. Basically, take a quick glance at that. That tells you all the things that if you hear today, you lose money on, you can't hold it against me. And hopefully you just read that. And now let's get into my bio. Okay, there's a picture. I guess I was a little younger then. But anyway, you know, my nickname is the Red Dog. Okay, I could, over drinks, I will tell you how that came about at some other point. But for now, just take it for what it's worth. I'm the Chief Strategic Officer of T3 Trading and T3 Live. I've been trading since 1999. If you haven't seen me, I've been on Bloomberg, CNBC, Fox Business. I've been, pretty much all around Wall Street as far as in publications. That is my Twitter handle. And really what I love to do is I love to do triathlons. I've done about 50 of them, including 2 Ironman, and I try and raise a lot of money for charity. Okay, that is my balance, and that is my little resume. Everyone has a little resume. Well, that is my resume. So that is why you're out watching this, because I've been doing this for a long time. I've seen multiple markets, and I've experienced many different types of stocks, many different types of ranges, crashes, you name it. I've traded through it in the trenches. So I've seen a lot, and hopefully in this maybe 15-minute video, I could teach you and I could speed up your learning curve. So first of all, you all heard of Facebook. Let's go right back to where Facebook is now. Okay, let me give you 5 fast facts. 430 billion market cap, on track for 38 billion in revenue this year, 1.9 billion users, up 294% since the IPO. Don't you wish you owned that? Don't you wish you knew the pattern to potentially find that? It's actually up 30% year to date, even though so many people say it's overvalued. And right now, it might be very loved, but I'll tell you right now, it wasn't always that way. Back in the day, there were a lot of haters out there. A lot of people telling you all the reasons why you shouldn't own it. Same way a lot of people are out there and saying you shouldn't be in the stock market. You need to educate yourself so you could drown out the noise. So here we go. If you look here, you'll see even pre-IPO, they were saying Facebook plus Instagram equals one big acquisition flop. Okay, Barron's, I remember this. I was long it, I think, going into that weekend, and boom, they said it's worth $15 when it was at $20.79. Great call, guys, right? Then you have, in what is that, 2014, when it was at 57, Facebook will lose 80% of their users by 2017. Look at that. We are 3 years later. I don't think they lost 80% of their users. Advertisers want page views, so they try and say the craziest things ever, so you read their stories. Then here, what is that? January 15th, Facebook was at 76. Facebook is dead to us. What teens think about 11 of the biggest social networks. If you listen to that, you might have sold and might have got short. You could have blown up your trading account. Anyway, here we are, 2015. It's even higher. Why is Facebook in decline? Yada, yada, yada. I could go through so many of these, but Facebook now is 150. So what I want to do is I want to rewind a little bit, because I like to show you proof. I'm not a Monday night quarterback, and I'm not telling you, things that you should have known before to get involved, prior. I want to show you in the moment, okay, of things, how we navigated it, what we saw, and explain why. So when we see it again, you can get involved, or when you see it again, you're no longer sitting on the sidelines. So this is actually a little entertaining. So sit back, grab a beverage, and watch it for the next minute or so. You might know who this guy is. Well, from time to time, I actually do a little bit of an episode with him.
When it comes to reading the charts, Redler's got some serious cred right now, I got to tell you. I mean, look, a bit more than a year ago when the S&P 500 was trading at 1350, Redler told us that the lost decade of stocks as an asset class was over, a good call, and the charts indicated we were about to witness a major long-term rally. Again, real smart. He said the sky was the limit for the S&P, and then it would hit 1700 by 2015. Fast forward to right now, and that key benchmark is we're halfway there at 1539. It's giving you a 14% plus gain from where he told us to get bullish on the market in February of last year. Sweet. How many else did that? I can count them on one hand. Redler nailed the direction of the market, and now he's saying, it's him put this in our head, he is saying it's the right time to go positive on Facebook, even as it was down today in a fabulously up market. What does Redler like so much about this pictograph of the action? Okay, first of all, Facebook has been forming what's known as a cup and handle pattern, right? Okay? And that goes back basically to all the way to its disastrous IPO. We've talked about the cup and handle pattern before, right? I mean, you're familiar with it. It's one of the most reliably bullish formations that technicians look for in a chart. First, you get the cup-shaped bottom. There we go, okay? And then after the stock rebounds, it starts pulling back while trading in a tight range. That's exactly what happened. That gives you the handle. Once the stock breaks out from the handle and the pattern is finished, it's typically followed by a monster rally. Now, Redler cautions that these patterns don't always trigger 100% of the time, or even close to 100% for that matter. But if the cup and handle holds true, then he thinks the resulting rally could carry Facebook all the way back to where its botched IPO initially started, the $38 to $42 range. How does Redler get that target? The size of the rally after a cup and handle pattern is generally equal to the depth of the cup, which is Facebook's case, 14 points. That's why Redler believes the stock could only have a 14-point upside move from here.
So basically, that's one of the segments that I did, and that was well before the major run of Facebook. But what was important about that is I sent him the chart of the cup and handle pattern, okay, which is one of the most reliable patterns in the market that helps identify big winners. Why does it do that? Because it shows big institutional money accumulating stock, getting the flow tight before a major run. And then we overlay our technical analysis, and then we get entries and exits and targets. So this was what I sent him basically then. Very simple, right? We as technicians, we name patterns that look like a certain situation right here. This was the post-IPO high. If you remember, Facebook was a disastrous IPO. It opened up at 45 and went straight down. We have a different set of rules called the Art of the First Day. That'll be a different video. So what happened really for these 2 years, Facebook wasn't making any traction in mobile. You had institutions, mutual funds, you had everyone accumulating this stock. And sometimes as an investor, it's hard to accumulate because you never know if, like Barron says, it's going to $15, okay, which it didn't. Finally, boom, you had a big earnings report. They showed that they could monetize search, and you had an igniting bar, what we call. Okay, it broke above what was a handle here, okay, but it gave you a big gap. So lots of traders are not long into earnings because it's risky. So what you have to do is come up with a plan thereafter. So here was our post-earnings move. This was a bull flag that got put into place. So I put together a note and a strategy every single time on how to handle a situation like this. And the way you do it is two things. One, when it gets above the top end of the flag, which is 40, that is a way to buy and put a tier together. It goes above the post-IPO high of 45, then the sky's the limit. Then what you have to do is you have to overlay, obviously, a system to hold, to navigate, depending on your time frame, but we'll get into that in a little bit. So right here is your cup and handle pattern. If you were sitting there waiting with a strategy to buy, you had 40, you had 45, and then you had to navigate. And this is what happened. This is your after. So here's your cup and handle pattern. Right around here is when I had that little segment with Kramer. Here I said it can go back to the IPO high, went back to the IPO high, then you change your strategy. Here's 40, here's 45, broke above that, and then basically gave you a move to like 50, pulled back. For those of you who do follow me, you know that I love the Red Dog reversal, which is explained in other videos. That could have been another entry or a swing entry based on the first pullback. Came up, then you had a pro gap on another earnings, and then you had another small little RDR sell. But anyway, here was your cup and handle pattern. Over the course of a year or so, this trended to the upside. And this is only 2014. Okay, trended to the upside. Now, if you're an investor, you know what? Usually you could stay involved in a stock as long as it stays above the 50 and 200 day. If you're a swing trader, I talk about the 8 and 21 day. So this on a stock investing situation was perfect. You didn't even have to, have a bit of sweat on your brow. And as a trader, if you were a swing trader, also never broke below the 21-day in the first move from about 40 to about 72. And if you actually did the depth to the actual peak here, this was about 35 points, and that was the measured move for that one. But that was then, and this is also your way to navigate it. I talked about a few different rules. I'm going to give you a sneaky peek to my rules, okay, which you have to follow in order for trade management. Again, if you're a long-term investor, there are ways to manage your trade if you're a swing trader or an active trader looking for cash flow. So here are some of my moving average rules real quickly, okay? You want to be long when your stock or your sector is above the 8 and 21-day moving average, okay? You want to ride that. That means there's momentum. That means there's strength. You could usually add on breakouts, etc. You do not short this. You do not short it. A lot of people will say there's a high valuation. You saw all those articles about Facebook, about the high valuation, how they're losing users, etc., etc. You know what? The charts don't lie. They were always above the 8 and 21-day. When the 8 and 21-day break, maybe you sell a little bit, get tactical, but really you don't have to worry about getting out of a long-term investment unless it breaks above the 200-day, and then you can always get back in when it gets reclaimed. So if you look at the next chart, this was more of your long-term chart. This is, remember the first slide that we put right here? This was the cup and handle. Took 2 years to get into place. And then look at this beautiful trend. How could you find the winner? You could find it with a cup and handle. How do you stay with it? With moving average rules. If you know you're in a long-term investor, this was never below, besides this flash crash here, the 50-day moving average. Okay, and look where it went to. It went to as high as 155. Okay, this is a huge winner. You could read Investors Business Daily, How to Make Money in Stocks, and then you go over the cup and handle pattern, or you can Google the cup and handle pattern, and you will see some of the massive winners out there that start from this pattern post-IPO. Then you use some pivots, and then you use some moving averages, and that is how you find a good long-term investment. Okay, if you then trade for cash flow, you trade for alpha, you're a swing trader, you trade for P&L. This is on my note every single day with different types of strategies to navigate it. So let me bring you to where we are today. So this way, if you do want to figure out if it's a buy, sell, hold, or maybe an add, or how healthy it is, let's go right to the chart that's live, because I made these slides this morning for you guys today. So let's go down, or let's go back to eSignal. Right here, you'll see I showed you these before, the cup and handle pattern, which was right here. I can mark up any chart. Boom, there you go. Here's when it broke out above those two pivots. And then this really was your macro trend that never got broken. Okay, and then here you have actually a more accelerated trend. So we talk about trends, right? Macro trends for the longer term investor, and then some micro trends for the active investor or the active trader. This one broke here. What did it do? It broke the 8 to 21-day, came in, held, and then it created a new trade right here. And here you have this accelerated trend that actually just pulled right back to it and tested it. So for today, I actually got long Facebook. I haven't been long Facebook in a while. So let's get to the daily chart, which I sometimes post on Twitter. I put in my note every day, and here you go. This is your daily chart of Facebook. Facebook reported earnings after a big move. What did it do? It just consolidated, came in, held the 50-day. So now, if you are very, very active, what I would suggest to you, only if you're an active trader, if you're an investor, stay the course, the trend looks great, this is where the trend is. Okay, you could be long Facebook versus this spot, 147.25. This right here would be your stop. What did Facebook just do? It just broke a little bit of a descending trend line, meaning here was your top, came to it and failed, came to it and failed, came to it and failed. This time, woo, looky, it came right above it, and now it's looking a little bit better. If you're very, very active, you could use this as your stop. In my opinion, if this is going to go back to highs over the course of the next week or month, okay, it probably doesn't break back below this 147.25, but if you trade very actively, maybe you want to use today's low as your stop, which is 148.42 if you're a little tighter. But all in all, this trend has been strong. High beta tech has been strong. There's been lots of ways to navigate this. And this actually just wound up getting back into play after a month pullback from earnings because it got out of the band and is looking a little bit healthier. So at this point, if people could say, hey, the valuation's too high, they're losing the tweenies, whatever they call them, viewership, they're all going to Instagram, which they own, or they're going to Snapchat, which has a much higher valuation. Don't believe the hype, believe the technicals. Short term, we're above the 8 and 21 day. Intermediate term, we're above the 50 and the trend. So the key to your process is finding out what time frame do you want to live. Are you a long-term investor putting money in every single month to a 529 or 401k in an S&P fund? Or are you the guy that wants to find big winners and have the risk tolerance to hold them over time with some kind of navigation system or trade management system? Or are you a swing trader who are looking for the fastest, most active go-to names, which is what I tend to do because they move. You have to have a lot of different strategies on how to handle that and a whole risk management system and you need a lot to learn to be doing that. And then if you also are going to be trading for cash flow and alpha and for a living, you have a lot to learn, and it's no get rich quick scheme. It's an in-depth, long-term situation where you're in a grind. I talk about routine. I'm up every day at 4:45 in the office at 6:30. I'm writing my note. I'm doing my videos. I'm trading, and then I'm doing education. I'm always working on my craft, just like if you were a lawyer, a doctor, a teacher upgrading their their education plan every year or two. Don't they have to come up with a new plan to teach the kids to keep things fresh? Well, as a trader and market participant, you always have to be fresh. You have to know what type of market you're in, how things move, who are the new players. Are they computers, which now are 26%, different from when a few years ago, from when the market makers were there or when the specialists were there. So everything continues to change. So what I'm going to try and do is I'm going to have many volumes of this type of format where I show you past winners and how they won. So this way you can see how it happened, because patterns repeat themselves. And within each volume, I'm going to go over different sets of rules that I follow that keep me in the game and keep me sane, and then show you what I'm doing right now. So maybe you could join along and make some money after learning a little bit about how you could have navigated in the past, and then look for the next situation that does present itself. Once again, my name is Scott Redler. Thank you for watching this entire video, and I look forward to you watching the next one. Have a great day.